Yo, what's going on, everyone? Welcome back to another video. I just want to quickly give an amazing deep shout out and recognition for 10K subscribers. It means a lot to me. You guys have grown my account. I would never even imagine being to 1K subscribers, let alone 10K, so it means a lot to me. So thank you so much for all the support and love that I've been getting. And yeah, let's just keep going on. I'm going to be uploading a ton of more videos, and let's just keep running this up together. So today's video is going to be on expansion versus the retracement. This is something that a lot of people do get confused on. And for example, right over here on gold, we can see that the market is retracing, and a lot of people tend to assume that the market is now reversing, or they get confused on which POI is correct and which one isn't. So let's just give a quick little review of what the expansion versus retracement even is. So when the market is pushing up in a bullish market, it creates higher highs and higher lows, obviously. Now the expansion, it's pretty self-explanatory. It's basically the market pushing up, and the retracement is when the market is making that higher high to higher low. Now obviously we can see this when we make lines and theoretical examples, but on the live chart it's never that simple. The market is just always doing stuff like this, right? It's so confusing, and then in your head you're just like, damn, is that Wyckoff? What's happening? In my rule of thumb, it all relies on structure points. Now we have something called macrostructure versus microstructure. Macro, I'm not going to give I'm not going to give an in-depth example. I'm just going to give you guys a quick little explanation and summary of what it is. So microstructure is basically the smaller time frame structure when the market is creating tons of structure, highs and lows. Like you can see, we created a low and then a high, higher low, higher high, and then lower low, lower high, lower low, lower high, etc., etc. So this is all microstructure. Now macrostructure is the opposite. Macrostructure is when you're on the higher time frame, such as the daily, 4 hour, sometimes 1 hour, but mostly daily, weekly, and 4 hour. And even though you do see stuff like this happen, right, you'll see a lot of structure forming. Macrostructure allows you to identify where the overall market is, what's the overall flow, and what's the overall structure of the market. Let's say the market did make a big sell-off just like this, right? Now, from even smart money traders, they're getting confused at this point. They're thinking to themselves that, okay, this is a big retracement down, it's probably sells now, correct? Because then they're on the 1 hour time frame looking at points of interest, trying to sell down over here, trying to sell over here, and then even trying to sell over here. There's all these levels they're selling at, and then at one point you see this big move back up, and you're just confused on why none of these POIs worked out. Now this is where micro and macro comes in, and this is my specialty. I love using this in my trading so much. It keeps things so simple. So it all goes back to order flow and understanding institutional order flow. The best way to find out what the order flow of the market is by going down to the weekly time frame or the 4H and the daily, and just drawing a quick little line to see how the market is flowing. Now other institutional traders have their own little way of identifying it. I like to keep it simple as possible. The order flow, all flow really means is where institutions are getting in and getting out, where they're pumping money the most. Now I could be on the 1 hour time frame and assuming that this is order flow, and so is this, and technically I would be correct. But because the institutions are not trading these smaller 1 hour, 15-minute time frames, they're trading the big boy time frames, like the 4 hour, daily, weekly, even monthly. Actually, no, not even the 4 hour. From what I heard, they're trading the weekly, monthly, and even higher sometimes. They have a lot of money to trade with, so it doesn't make sense for them to be going down to the smaller time frames and trading with that small amount of price action. Sorry, not small, but that small limited amount of price action range. So what's interesting about this big move up and this big expansion move up is they both happened after a retracement. We can see that after so before this expansion happened, we have a retracement, and then the market expands. Now at this point, when the market does expand, there's people chasing the trade, and this is my rule of thumb. Don't chase a trade, right? If you're trying to chase the trade, most likely you're not going to get in. The rule of thumb is to enter when everyone else is fearful, and be patient when everyone else is greedy. If 99.9% of everyone is saying buy this stock, it's gonna 10x, 20x, or buy this crypto, it's gonna 30x. If someone that doesn't even know anything about crypto is telling you to buy a stock or crypto, I promise you, everyone else know. The majority, the masses, they all know about that crypto. Shout out to BGFX. I learned that analogy from him. But yeah, so this is the same concept in institutional trading. If something already happened and you're seeing it, for example, right over here, nothing happened. But if this already happened and you're seeing this big move and price is over here and you're thinking about getting in, most likely there's 30 other traders thinking about the same thing. And over time, this is what's going to happen. The market's going to go down and then go back up. So this is the strategy of expansion versus retracement. When the market is retracing, you have to understand that all it's really doing is it's going down to create a new higher low and then a higher high. Now, from structure perspective, we all know that's just an uptrend. But from an institutional perspective, what we can identify from this expansion move up, let me make this like black, right? And then this retracement back down, let's label this as, let's not even label this, let's use a parallel channel, right? This retracement back down, to us institutional traders, this is clear manipulation. Let me label this as manipulation. Why? Why is this manipulation? Well, like I said before, if majority of the people already know that something is happening or has already happened, most likely everyone else is going to be onto that move as well. So if we see this big crazy push towards the upside, everyone's gonna buy, right? Every single person you're thinking of is buying now. Everyone's buying. Now what happens? All those people that are buying, they have their stop losses resting all over here around this big move up. Now for the people who entered off of the low, maybe somewhere down here, they're fine. You know, they didn't wait for that. Sorry, they didn't chase that big move up. They got in at a good price and then they got out. For the people that are chasing price all the way up to here, look what happens. The market goes down to take out all those stop losses. Now to us, we see this as the market creating a higher low and then a higher high, correct? But it's that simple. You don't even need to know institutional trading to understand this concept. All it is structure. We have a low and we have another higher low and then a higher low and then a higher low. So we know that these retracements are nothing. All it is just confusion to make you confused on whether the market is buys or sells. I'll show you guys a clean example right away on GJ right after this. So after that retracement, we're followed by another expansion. So we know that the banks or institutions or smart money, they're dumping money in areas after retracements, right over here, right here, right here, right here. There's institutions getting in on that price. So when you do see a retracement, depending on if you're actually assuming that the market is going to go all the way down to hit all the stops here, here, or depending on if you're just looking for a small scalp, which is fine. But if you are looking to sell in this retracement phase, just remember that the flow of the market is still up. And sometimes you'll see really clean things like liquidity resting over here. For example, let's make this a little cleaner. So you might see liquidity resting over here, right? Liquidity clear. So you might see money resting below here, and you might say, okay, price is most likely gonna go down here. I might as well take a sell. Now, it's all about in terms of probability. Probability means what is more realistic, not what's more appealing to you, but what's more realistic. If the market is overall flowing up and has been following this uptrend pattern, this higher high, higher low structure, what is the probability what is the probability of price action completely selling off compared to the market using this level as a demand zone and then from here pushing up, or using the bottom level as a demand zone and then pushing up, right? So even though the market can clear liquidity of the lows over here, it can easily do that. It can go all the way down just like this. Let me show you guys. The market can easily fall down to here, right? Down to here and then go up. It doesn't have to necessarily use the first zone, and that's where risk management comes in. You have to use proper risk to actually make it in this game. You can risk 1% here, you get stopped out, call it a day, wait for the next zone to come out. Now let me show you guys this amazing gold call out I sent to the Telegram group chat. Right over here, I said, someone had said track your analysis on gold. I was out, so I couldn't send it, but I said still bullish, 1884 should hold, if not gold going down to 1853. 1884. Now my analysis is this right over here. Let's go down to the 2 hour. Let me actually start off on the 4H to explain all this. So overall flow, like I said, I trade with the flow. Now at this point right here, flow is down 100%. If I draw a line, I can easily see the flow is down. Now up to here, what would you say? Obviously you would say, okay, flow is now moving up. Now if you're a really extremely intensive higher time frame trader, you probably wouldn't even be looking for buys. You're trying to simply catch that sell maybe from here and then back down, right? Now me, I'm a type of guy who trades with the trend. If the trend is switching to the upside, I'll just take buys. If it's going down, I'll take sells. So basically, starting from here, we can see that red means consolidation. 10, that basically means manipulation. But what happens right after that retracement? We have that expansion. Now, up to here at this point, in my head, I'm thinking, okay, we have a really clean last institutional down candle before the major move up. And there's also an institutional candle down somewhere here on the smaller time frames. My two areas of interest are going to be this one and then this one, these two areas of interest. But what ended up happening is price decided to continue going up, right? And then the way I caught this buy, actually, sent this one out to the Telegram as well, is this was pure structure, clean pure structure. On the 1 hour time frame, we see this range, right? And then we also see this little downtrend structure happening on the market, right? We see this downtrend structure happening, and then the market pushes up. It breaks a previous lower high towards the left, right over here. Now, to me, that wasn't enough confirmation to actually take a sell, or sorry, to take the buy, because look at this. Even from this, we don't have any bullish structure forming. It's all just consolidative range. Now, when the market did finish that low, it finished this retracement down to here, and then the market pushed up, we saw that the market actually is now creating proper structure. We broke past this previous lower high, and then we broke past this previous lower high as well. These are two lower highs that the market broke past. So in my head, I'm thinking, all right, let me find that last down candle before the major move up. That was the cause of that BOS, and from there, I'll set my limit. Now you could go down to the smaller time frames and look for the sniper entry. I didn't do that, but market triggered us into the pip, and then from there it reversed. Now, once again, someone said, okay, weren't you focusing on this one, and this one? Now, I was, right? But if you see another opportunity, take it. You don't have to stick to your original analysis as long as you're following your rules. If your rules are there and the trade makes sense, completely take it. Because even if I did get stopped out, look at my stop loss. That's 50 pips, and the pips don't matter. It's about how much you're risking your lot size, and that's still 1 to 2% on my account. So even if the market did tank, I would simply focus on this level and then this level, and I'd be completely fine. Now, once again, the market goes up. We have a retracement, and right after that retracement, we have an expansion. Now, just looking at this expansion, I was not interested in buying in this area at all, and I'll tell you why. Now, there's so many areas of interest. There's one right over here, there's one right over here, and then there's one right over here. Now, I was not focused on this one at all, simply because these two are closer to where the price actually started the expansion. This one is way too far up, and like I said, the market makes deep retracements. It never ever goes to the cleanest, or not cleanest, but the closest OB. It goes down to the most recent one that was the cause of the BOS. The reason I was not interested in buying down into these levels of interest was simply because I saw no structure forming, right? I saw no structure going towards the downside. I didn't see price actually making it down here, at least for now, because if we look at the left, we can see every time the market consolidated, it never really made a deep pullback. It just consolidated in the range that we drew out, and then from there it pushed up. So in my head, I'm thinking, all right, no way price is going to come back down, and if it does come back down, overall we're probably going to be bearish. Now, once again, we consolidate. Market pushes down to take out the equal lows that rested over here, tapped into a higher time frame institutional candle, and then from there we pushed up. I didn't catch the buy, but for this one, which is the 1884, I'll explain this so clean and so simple. So we have this area where the market is ranging, right? The market is overall basically is ranging in this red zone. We did create equal lows, but like I said, the market is not creating deep pullbacks. It's just going up and up and up. So in my head, I saw, okay, the next time the market expands, I'm just going to look for that area, sorry, not that area, but I'm going to look for that institutional candle that was responsible for that expansion and break of structure. So if we go down to the 45, I think it was, we have these two institutional candles, one being right here and the second one being over here. Now, someone might say, why didn't you look at this one? I was looking at both, in all honesty. I was looking at this one and this one. I set limits for both. This one got triggered instead. Now, let me explain why this one got triggered. Like I said, the market is going to retrace back into that overall expansion, the original expansion, and what it's going to do is it's going to go down into that last POI, which would be your institutional candle that was responsible for that major impulsive move up. So we all know what an order block is. Shout out to ICT for treating order blocks or whatever, but we all know what OBs are, right? We see an OB over here, we see an OB over here. Now we can differentiate from something like this and something like this. We know why this is significant and why this is not. We know that the overall trend is up. This expansion move caused that break of structure, or continuation of structure rather. It cleared liquidity because obviously we can see that the market created these equal highs over here. Sellers sold, sold, and sold, and obviously that means money is resting above. So overall structure is up, and then we have that major expansion move up that was the cause of this BOS. At this point, we set a limit at this area, 1884, exactly at 1884. Let's do this. And then as you can see, price comes in perfectly, taps us into the pip, and we do see a little bit of drawdown for about 16 pips, and then the market overall continues its impulsive move towards the upside. Now, let's analyze the structure now. Now, structure is still bullish. We can obviously see that. But if we look at gold, we can see that. Look at how much liquidity it left over. It left equal lows over here, right? And then it also left some type of, I guess you could say, equal lows over here. Technically, you might say this is the market taking out liquidity, but in my opinion, I want to see the market tank to take out all those stops. We have equal lows over here, and then we also have a ton of equal lows that did get taken out, and then we have equal lows resting over here. We have equal lows right here. We have tons and tons of liquidity towards the downside. So when the market did finally make a deep retracement, this was my thought process and my clue that the market may possibly be bearish for the time being. It may sell off down to take out some of the liquidity, maybe tap down into this institutional candle, and then from there go bullish. So obviously this is all out of perspective. I don't see any of this happening yet because the probability is price is going to continue going higher, right? Why do I say that? Well, because look at the flow of the market. Like I said, the flow is still bullish. There's no bearish flow. This is not order flow. This is just the market creating a high and the market trying to break above this previous high. Until we see something like this happen, then we can assume there's bearish order flow. But in this case, there isn't. Now, a perfect example would be GBP, JPY. I've showed you guys this pair or this trade already, but order flow in macro and microstructure. We have a macro low, a macro high. Once again, another macro low, and then another macro high. Now, people see these big drops right here. They're going crazy. They're on the 1 hour trying to sell. Now, look at how confusing and how misunderstanding the time frames can be. Imagine you're all the way over here. You see this big drop, and then you see this big drop, and then you see this big drop, and then you're over here. Now, what you're going to be doing is you're going to try to take a sell. You're not going to look at how much it's dropped. No, you're not going to be looking at, oh my god, price is close to an OB. You're not going to do that. What most of the majority of people do is they're just going to be looking at this sell. They're going to be trying to catch a sell from this OB or this OB or this OB, and they're going to completely forget that price is so close towards a strong area of interest. And why does this happen? Well, it's because your mentality changes. You get too greedy of getting into a trade rather than waiting for the proper trade. And like we said, when price is really, really, really low, that means price is discounted. That means banks and institutions are looking to but they're looking to get in for opportunities towards the upside. So let's play this out really quickly. Let's go down to the 4 hour, play this out a bit quick. Sorry about my click noise. Now, boom, look at this. Now, we're smart because we're institutional traders. We're looking at the higher time frames, right? Now, you could have easily caught this sell right over here. You wouldn't expect it from here, right? If you were looking to sell, you wouldn't expect it. But as you see price go up, you can see there's an institutional candle. So obviously price is just going up to mitigate that institutional candle, and then from there go down. But for the people that are on the 30-minute looking at this microstructure, what are they doing? They're not realizing that price is about to tap into an institutional candle. What they're doing is they're so addicted to sells, they completely forget. And when finally the market goes up, let's say this is their POI. Market taps in, rejects a bit, you get happy, and then it stops you out. You're like, okay, maybe this wasn't the right one, right? Because TraqFX said that the higher one is always correct. So what do? They go down to this higher one over here. People might say, okay, it broke structure towards the left, it makes sense. Well, look what ends up happening. All right, let's just speed this up down to the 4 hour time frame. Let's see what the market does. Now, boom, right away, it stops you out. It reacts and then it stops you out. So you have to understand trend and structure. You can't just use any single institutional candle because it looks clean and broke structure. No, you have to keep in mind of macrostructure and microstructure. I know that this is a macro low. This is a macro high, macro low, macro high, macro low once again. And once I got tapped in, I know that I'm getting in for the cheapest price possible. Why? How do I know this is the cheapest price point possible? Simply because This institutional candle is the last institutional candle that was the cause of all this bullish momentum. Below it, there's nothing that really interests me. It's all just no structure. It's just bullish momentum. This is where structure started to come in play, and this is where the order flow started. This tells me, this big move over here tells me that this is where institutions bought once. This is where institutions bought twice. This is where institutions bought a third time. We know this because we're understanding the macro and micro analogy of where price action is going. Now from here, TP got smacked for 434 pips, 39 to 1. I showed you guys this before, the before and after. Now I did take a sell over here. Someone might say, okay, you're contradicting yourself, but this was a complete scalp trade. I can explain this in a different video. The scalping video is coming real soon, but this was a clean little scalp trade for 100 pips. I didn't hold it for 100. I ended up getting out just at this point right here, so technically it was 64 pips, but either way, pretty decent trade. But anyways, I hope you guys learned something from this video. When you guys are watching this video, take notes, rewatch it again. I don't care, just make sure that it gets stuck in your head, because I don't want people to be confused after this and coming at me saying like, oh, you know, I'm doing what you say, but I'm still losing money. Either you're not using proper risk or you're not actually doing what I say. So anyways, once again, thank you so much for 10k subs. Course is releasing on June 2nd. June 2nd, the course releases. I will be picking the winner soon. Make sure to comment on my Instagram, TraqFX, TraqFX. My Telegram is also TraqFX. That's it. I don't have any other Telegram groups other than the one in my description. Make sure you guys join. And yeah, thank you guys so much for watching, and have a good one.